Okay, hello everybody. Welcome to Korean Atlanta Mentorship, and we're just going to do another review of Velocity Banking today. And today is Saturday, so I'm going to make this proclamation that if you're studying Velocity Banking on a Saturday, whereas everybody else is just doing chilling and Netflix, playing computer games, who knows what they're doing? Maybe they're just sleeping in bed right now. I'm going to proclaim you will be successful, right? Because I am studying Velocity Banking right now on a Saturday and doing it with you. So let's get started. What is Velocity Banking? All it is a debt payoff strategy using a line of credit as your main tool or your main operating account. So to do Velocity Banking, we only need two things. Number one is a budget, and then number two as a line of credit as our main operating account. So here we have a budget. We have really good income, $130,000 a year. That leads to $7,700 a month. Our expenses, a little bit of savings left over, $3,887 of savings every month. And we went crazy on the credit card. So 7 credit cards here and a 250K mortgage. And then we got our other expenses, food, gas, insurance, etc. Now we're going to focus on our first goal, which is to get rid of our $102,000 of credit card debt, which is a lot, right? I've seen in YouTube videos where it's like I pay $10,000 of credit card debt in 6 months, and so many people are watching it because to a lot of people that's a lot of debt. I remember even 2 years ago I had $100,000 of credit card debt, but because I knew the strategy, um, I never panicked. I slept well at night, right? Now, before we actually get into doing velocity banking, I just want to mention one thing about home affordability. So many people, I think, make the biggest real estate mistake, which is just overpaying for homes. So you can use a tool like Zillow Affordability Calculator, and if you type in your income, $130,000 of income, and a sizable down payment, with all your debts combined, it'll show you how much home you can afford. So some people might be thinking, oh my goodness, $130,000, that's so much, right? And then if you type in, so let's just go ahead and add up all of our debts except for the mortgage. That's about $3,300 of debt that you have. Zillow says you can only afford a $100,000 house if you have a $50,000 down payment. And I think that means that you'd only have a $50,000 mortgage, right? Because $100,000 minus 50, you pay 50 with the down payment and then 50 with the mortgage. Basically, if you make six figures and you have this much debt, you ain't gonna get I don't even know if home prices, they actually have homes at this price in Georgia these days anymore. You know what I'm saying? So we got to really be careful with our debt and how much we can pay for housing, because I'll tell you what, if you overpay for housing, that's like the biggest number one red flag real estate mistake that most people, they love to, they want to be a part of. It's like they want to jump into um, that poisonous creek. I don't know if that's the right way to say it, but let's just assume for now, yes, we do have these credit card debt and we have a 250K mortgage. Now, according to Zillow, we can't afford it, but we'll still hopefully get out of it. All right. So uh, now let's do velocity banking. So we have one column here for the average American. Number two column is for velocity banking. We assume two things: same income. So if we had more income, that'd be fantastic, but we're going to assume the same income. And then number two, we're going to assume that we have zero savings, right? So zero savings because we're going to use our line of credit as our main operating account, all right? And so we're going to do this, copy these expenses. And then if I do this, where it's just income minus expenses, we're going to have something called cash flow. And this cash flow number will look exactly the same as our savings until we start using our line of credit as our main operating account. So what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. And there's different flavors of lines of credit. So a credit card is a line of credit, but it's a little bit inflexible because you can't use it to pay everything. Whereas we're going to assume we have a home equity line of credit, $130,000 of credit line available for us to use, and we can use it to pay anything, right? Loans, you can pay the bill of this credit line itself. When the monthly payment comes, just borrow it from itself. That's how awesome it is, right? And so we're going to assume that we have a $130,000 tool like a credit card, but it's going to be based on the value of our home, and we're putting our home equity as collateral. So we're going to put our entire paycheck into this line of credit because that's the actual strategy. Once you've done some financial reengineering with your finances, but we're going to take our entire paycheck, put it into a line of credit, expenses out, and then we're going to see our cash flow um, decrease that number. And you might be looking at this, well, it's only $387. What's the difference between this and this? Well, we haven't finished all the steps. So in order to make this our main operating account, we got to move some debt into it. And so let's go ahead and move all this credit card debt. So there's 7 credit cards here, and this is $102,000 of credit card debt, right? So 102,000. Okay, so just by simply moving this debt, what did we do here? We've gotten rid of the payments, right? So 0, 0, 0, 0, 0, 0, 0, right? And if you want to know how to calculate this minimum credit card payments, just go to bankrate.com, minimum credit card payment calculator, and they'll give spit out a number. Every credit card lender is different, so they might do it with like a percentage plus interest, but or some other way. But if you use Bankrate, it should just give you a safe number that you could use for your calculations. And as you can see here, on day one, when we're doing the average American way, we had $387 of savings. But if we do it this way, now we magically have $3,700 of cash flow. Okay. And so again, paycheck into here, which satisfies the minimum monthly payment. And then the second benefit of that is minimizes the interest, because the interest is going to be based on the average daily balance, right? And so let's go ahead and do this. And then what we do is we take the previous month's balance plus the previous month's interest minus this cash flow number. This cash flow number is 3701.12, right? And we have to add the interest because the interest is calculated after every single month. So let's go ahead and do that. And then multiply it by the interest rate, which is in this case 0.9, and then divide by 12 because you need to get the monthly interest because this is always quoted annually. And then now what we do is copy and paste these 3 formulas. And then let's see how long it takes for us to pay off. So as you can see here, it will take us 31 months to pay that $100,000 of credit card debt. So 31 months and then 107K of credit card debt, or 102, my bad. Is it 102? Yeah, it's 102. All right, so 102 of credit card debt paid off. And we got all that covered. And then the next thing is this $250,000 mortgage that we supposedly can't afford, according to Zillow, right? If we were in that situation originally. So let's go ahead and now attack this mortgage. Now you got to ask yourself, hey, um, am I going to put my cash directly into the mortgage or use it with the line of credit? It's up to you. Now, here's what I'm going to say, that the option to overpay your mortgage with your savings or your cash is available to everybody. Now, why don't people normally do that? Because when you put cash directly into the loan as an overpayment, um, you can never really get it out, right? So that's why, as an alternative, you can use the help of a line of credit to do it, and it's much more flexible. It's easy, and here's the biggest benefit: you don't really have to think. See, the reason why so many people fail in personal finance is they think way too much. So if you ever use a budgeting app and it requires you to list every single thing that you're doing rather than somewhat approximating, which is what I do with my finances. Like, I'll have unexpected expenses, but I'll know on average I'll be okay. Um, that's what makes sticking to the plan really easy. And that's why I like using the line of credit. So if I do this and I directly pay the $3,701 into that mortgage as an overpayment, I can never get it back. And the analogy that I like to make is like you making an extra payment directly is like a UPS truck making a left turn. Uh, it will work, but UPS, I don't know if you know this, but UPS, like, they actually ban trucks from making left turns. In fact, just look at UPS left turn trucks. Look that up. But you'll notice there's a lot of articles about how UPS drivers, they just don't make left turns because they realize that if they do make left turns, that's a source of problems. Just like directly overpaying a mortgage, which is the default option that everybody has, nobody will ever do just because that liquidity and being able to pay, um, have access to your cash is so important. And not only that, being able to easily manage your money with one source by putting your entire paycheck into a line of credit is really, it'll make your life so much easier, right? All right, so now let's go ahead and do this. So um, I guess we just have to ask, if we moved, let's say, $7,000 of the mortgage principal into the line of credit, so this is 243, how long would it take us to get here on our regular amortization schedule? Which is, and most people, like I said, will never overpay, make extra payments to the mortgage in general. So 250,000 to 243 takes us about 2 years. Okay. Now, let's say we move that into the line of credit. So this will just be 7K into that line of credit. So plus $7,000. How long did it take us to pay that off? 2 months. So something that was normally going to take this 2 years took us 2 months, and we just rinse and repeat over and over again. So I'll just add another $7,000 here, right? Plus, I'm sorry, uh, plus $7,000, right? And then this will be, again, they call it chunking, or you just make repeated sweeps to your line of credit, and then just do it over and over again. And so we have actually a calculator here, the Velocity Banking calculator for Renatus students. And if you don't know what Renatus is, it's a educational company where I first learned Velocity Banking from, right? So, I learned this in 2017, and they had this cool calculator where you just input the information. Now, full disclosure, I make commissions from selling their education, right? So, because I'm an independent contracted marketer, and I always like to say that just because I want to train my audience that you should pay for stuff if you're gonna access resources and use it. But let's just go ahead and put it in what the balance of this of this mortgage is after about 31 months. So 31 months right here. So let me go here. What is the balance right now? It's about 241. So 241 is our mortgage, right? And then now we just got to put it in here. Put that in here. What was the original balance? It was 250. Okay. Interest rate is 6%, 30 years. And what was the monthly payment? 1498.88, right? So let's go ahead and put that in there. All right. And then now we just got to put in our income, expenses, and how much we want to move each time to the line of credit. You could just use a small amount, but the most important thing that you're going to learn from this is that you don't want to replace the whole thing with the line of credit, or it's not necessary to do a first lien HELOC. All right, so now let's go ahead and put in this number. So 7,700 right here, 7700. And then our expenses is everything except for the loan we're trying to pay off. So it's going to be 2,500 right here. Okay. And then what we're going to do is we're going to move, like I said, pieces of the line of credit. And this is, so let's just demonstrate this first. So let's say I get a first lien HELOC and replace my current mortgage with a 9% line of credit, 241677.22. You'll notice, yes, the payoff is way faster, 4.8 years, but look at the interest, 57,000. Now, let's say I do, small chunks, which is just, repeated payments, moving to line of credit, sweeping it from mortgage to line of credit over and over again. So let's do $7,000, 4.8 years, 57 grand. 4.5 years and 34 grand. So we essentially cut that interest in half, right? So let's say we even did a 30% credit card. Oh my goodness, let's do that 30% credit card. We only pay 3 grand more. So that comes out more on top than a first lien HELOC. I would never do a first lien HELOC if my interest rate was that low or there was a huge significant difference. It makes no sense to do it, right? I would only do a first lien HELOC if my home is completely paid off, right? Something that we should know. And some people might ask, like, what's the benefit of using a 30% credit card? Hey, Sometimes the best credit decision is not the best financial decision. So let's say you got like a $10,000 credit card and you're putting, $7,000 chunks on that credit card. And you're thinking, man, I wish I could increase my limit. If you do this with your mortgage and use a website like Plastique to kind of do that, in no time, I guarantee you, in no time, if you're making $7,000 payments with the credit card and repaying it, using it over and over again, they'll probably give you like a 30 or 40K limit, right? It's inevitable. You see what I'm saying? So even with the 30% credit card, yeah, you might have to technically pay a couple grand more, but there might be additional benefits. Plus, you might get all those rewards points, right? So it might just be the same as using maybe like a 9% line of credit. Okay. All right. So now let's go ahead and do 4.5 years. So 4.5 years. So equals 31 plus divide by 12 plus 4.5. So 7 years we're completely debt free. 7.08 years. And we paid off two 352K of debt, right? Because we got to add the 250 to this. So we are completely debt free. Woohoo. This is what you get when you study velocity banking on a Saturday. You're going to get this awesome knowledge that most people will ignore. They're going to work very hard and then they're just going to be like, oh, I'm so tired. Oh, learn math on a Saturday or Excel? Screw that. But if you're learning this on a Saturday, success, I think, is in your future. Okay. So that's it for today. Have a great day, everybody. Another velocity banking session. And we'll see you next time. It's Karina Lanta Mentorship.